Looking to generate consistent income from the stock market? Then understanding the options chain is your key to becoming a smarter options seller. In this video, we'll break down exactly how to read the options table, and how to use it to sell puts and calls the smart way. Section 1. What is the options table? The options table, also called the options chain, shows you all available options contracts for a specific stock and expiration date. It lists calls on one side, and puts on the other, with the strike prices in the center. As an options seller, this is your menu of income opportunities. Let's break down the key columns from a seller's perspective. 1. Strike price. This is the price at which you'd be obligated to buy, for puts, or sell, for calls, the stock if assigned. For sellers, your goal is to pick a strike where you're comfortable owning or selling the stock. 2. Premium. This is the amount you'll collect per share when selling the option. One option contract equals 100 shares, so a bid of $1.25 equals $125 in premium. 3. Delta. Optional, but important, delta estimates the probability of being in the money at expiration. A delta of 0.30 means roughly a 30% chance you'll be assigned. As a seller, lower delta means safer, but less premium. 4. Implied volatility, IV. Higher IV equals more premium, but also more risk. Sellers love high IV environments, but only when they understand the risk. 5. Open interest. This tells you how many contracts are open for that strike. More open interest equals better liquidity equals easier to get filled. Let's say you want to sell a cash secured put on Apple. You think the stock won't fall below $170 in the next 30 days. You sell the 170 strike put for $2. That's $200 in premium collected. If the stock stays above $170, you keep the full $200. If it drops below $170, you'll be assigned, and buy 100 shares at that price. Now flip it. Let's say you already own 100 shares of Apple and want to sell a covered call. You sell the 180 strike call for $1.50. That's $150 in income. If the stock stays below $180, you keep your shares and the premium. If it rises above $180, your shares get called away, but you still profit. As an options seller, here's what to watch for when using the table. Avoid low open interest. You might not get filled at a fair price. Beware of extremely high IV, it might signal big news or earnings coming. Always check expiration dates. Shorter term equals faster premium, but less room for error. The options table isn't just for traders, it's your toolbox as an income-focused seller. Master reading the table, and you'll spot opportunities the average investor misses.